Interest rate parity, or IRP, is a key concept in international finance. It states that the difference in interest rates between two countries is offset by changes in their forward exchange rates. For example, if one country has a higher interest rate, its currency will typically trade at a discount in the forward market. This ensures there's no arbitrage opportunity between countries. So remember, IRP links interest rates to forward exchange rates to maintain balance. A quota is like a limit set by a country on the quantity of a specific good that can be imported. Why? To protect local industries. For example, if a country sets a quota on foreign cars, it ensures that local car manufacturers don't lose all their customers. Quotas are a tool of protectionism, designed to give domestic industries a competitive edge. A tariff is a tax imposed on imported goods. Imagine you're importing shoes into your country. If there's a 20% tariff, you'll pay 20% extra as tax. The goal? To make imported goods more expensive so local products can compete better. Tariffs are another protectionist tool, but they also raise government revenue. Purchasing power, parity, or PPP, says that in the long run, exchange rates between two currencies should adjust so that a basket of goods costs the same in both countries. For instance, if a burger costs $5 in the US and an equivalent in India costs 250 rupees, then the exchange rate should be 1 USD equals 50 rupees. PPP helps us compare living standards and economic conditions across countries. LIBOR, the London Interbank Offered Rate, was a benchmark interest rate used globally for interbank loans. It determined the cost of borrowing money between banks and influenced rates for loans, mortgages, and more. LIBOR has now been replaced by other rates like SOFR due to reliability issues. SOFR is the benchmark rate replacing LIBOR. It's based on actual overnight loans secured by US Treasury securities, making it more transparent and reliable. SOFR is widely used in financial contracts like derivatives and loans. The IMF, or International Monetary Fund, helps maintain global financial stability. It provides loans to countries facing economic crises and promotes international trade. Think of it as a global financial safety net. For instance, if a country's economy collapses, the IMF steps in with financial aid and guidance. The World Bank focuses on development. Its goal is to reduce poverty by funding infrastructure projects, schools, and healthcare in developing countries. For example, it might finance the construction of roads or water systems in underdeveloped areas. Basel III is a set of regulations for banks, ensuring they have enough capital to withstand financial shocks. It strengthens risk management and requires banks to hold more reserves. The idea is to make the banking system safer after crises like the 2008 financial meltdown. A forward contract is an agreement to buy or sell a currency at a specific price on a future date. For example, if a company knows it'll need euros in 6 months, it can lock in today's rate with a forward contract, avoiding future currency fluctuations. A high debt-to-GDP ratio means a country relies heavily on borrowing compared to its economic output. For instance, if the debt is 120% of GDP, it owes more than it produces in a year. This could signal financial instability or excessive reliance on credit. The euro is the official currency of the Eurozone, used by 19 European Union countries. It simplifies trade, travel, and financial transactions across Europe, eliminating the need for currency exchanges. The FX market is where currencies are traded. It's the world's largest financial market, with transactions exceeding $6 trillion daily. It facilitates global trade, investments, and travel by allowing currency conversions. A currency swap is a financial agreement where two parties exchange interest payments and principal amounts in different currencies. Companies and governments use it to manage currency risk or lower borrowing costs. A trade deficit occurs when a country imports more than it exports. For example, if a country buys $500 billion worth of goods, but sells only $400 billion, it has a $100 billion trade deficit. This could indicate dependency on foreign goods. A floating exchange rate is determined by market forces like supply and demand. It's not fixed by a government. For instance, if demand for a currency increases, its value rises, and vice versa. A fixed exchange rate is pegged to another currency, like the US dollar. Governments or central banks intervene to maintain the fixed value, ensuring stability for trade and investments. The capital account tracks cross-border investments like foreign direct investments and loans. It shows how money flows into and out of a country's economy, apart from trade. Trade liberalization removes barriers like tariffs and quotas, promoting free trade. The goal? To boost economic growth by increasing competition and efficiency. Sovereign wealth funds, often referred to as SWFs, are government-owned investment funds. They manage national wealth, often generated from natural resources, and invest in assets like stocks and real estate for long-term growth. The balance of payments, or BOP, is a record of all economic transactions between a country and the rest of the world. It includes trade, investments, and transfers, showing whether a country is a net lender or borrower. Higher inflation reduces a currency's purchasing power, often leading to depreciation. For example, if prices rise rapidly in a country, its currency may weaken against others. High government debt can reduce confidence in a currency, leading to depreciation. Investors may worry about repayment risks or inflation due to excessive borrowing. Increased exports boost demand for a country's currency, leading to appreciation. For instance, if a country sells more goods abroad, buyers need its currency to pay. More imports increase demand for foreign currencies, leading to domestic currency depreciation. It's like spending more dollars to buy goods from other countries. Tariffs protect domestic industries by making imported goods more expensive. They also generate revenue for the government. Diversifying currency holdings reduces risks from fluctuations. If one currency weakens, gains in another can offset losses. SDRs, or special drawing rights, are reserve assets created by the IMF to supplement member countries' reserves, enhancing global liquidity.